Hi everyone, welcome to Light Pillar Conversations. I'm Saurabh.
I'm Vivek.
And today we'll discuss a very interesting question, investing in stocks versus investing in mutual funds. Vivek, 20 years in the stockbroking and the mutual fund business, and we have been asked this by almost all of our clients, right?
You're absolutely right. This question is not only for the young investors, but also the people who have been investing for the past few years in the markets. But before we identify the product, we need to understand the why behind it. And here the why is all about the financial goals, the risk which an investor would like to take to get that aspired returns.
But how does that matter? How does that make a difference to an everyday investor?
See, mutual funds are very stable products. Mutual funds are known to be that you park your money, you keep on investing money on a month-on-month basis, and you hold it till retirement. Stocks, on the other hand, are very exciting. You buy today, you have an opportunity to maybe sell tomorrow, to sell after a quarter, and maybe get some good returns. But there is a difference between both mutual funds and stocks. While investing in stocks, you need to have a very high investing knowledge, and you really need to have a lot of patience if you want to create wealth.
But as you said, mutual funds you invest and forget, and that seems to be a very decent strategy, right?
This is a strategy which everybody takes. But yes, if you work around the portfolio and you manage your portfolio properly, you can still get an alpha of 1%, 2%, maybe higher from mutual funds itself.
Yeah, but I think mutual funds, the way they help an average investor is that you give your money to a trusted brand, right? To a professional manager. He's managing a large portfolio, he or she. And you have a certain peace of mind. All the grunt work is taken care of. You're basically outsourcing all the hard work. Right?
So that's how mutual funds are designed.
Right.
That's a product. You have outsourced everything, as you rightly mentioned, and you as an investor only needs to look at one number, which is called the NAV, net asset value. If the NAV of the mutual fund portfolio or particular scheme goes up, you're making money in that portfolio or in that particular scheme. Or if the NAV goes down, you're losing that money. So you have given away all your attentions to a professional who is handling your money for you.
But then, is this the final notion that invest in a mutual fund and forget it till your retirement? Or is there something that people can do, be more active? Does that have any benefit for people?
See, active investing and passive investing, these two are two different lines of thoughts. But there is no precise answer. If you can manage your portfolio well, while doing it actively also, you can get those returns. And there are various ways wherein you can do this.
But okay, and we'll come to mutual funds a bit later. When we personally invest our money in stocks, there is a structured process that one needs to follow, right? I think that is something which we should talk about.
So when we invest in mutual funds, the process which we take care is a three-step process. The first is that we look at the economy at large. From the economy, we try to identify the various business cycles and thereby get into the particular sectors. Analyze at a sectoral level which sectors are going up, which sectors are going down. From there, we create and get our universe of stocks.
Right. But is the concept of risk profiling or understanding your risk appetite, is it relevant when we are investing in stocks also?
That is very, very important, and rather I should say that should be the first step before you define and you decide to invest your money into shares or mutual fund. You really need to understand what is your ability. Ability means what kind of money you have, for how much amount of time you would like to hold that investment, what kind of risk you are ready to take on those investments. With that, willingness is also important. For example, you have money, you have time frame, but you are not ready to take a hit in terms of volatility on your portfolio. When the markets are going good, everything is good. But there are phases wherein the portfolios may go down anywhere between, say, 5% to a 40%.
Yeah.
If you're okay with that kind of hit and the quality of companies or the scripts or even the mutual fund schemes which you have identified in your portfolio are good, then you can hold on to it. That is the willingness. If you are not willing to take that kind of hit when the markets are bad, then the allocations has to be little bit thought about.
Yeah, like October 2024 has been crazy when it comes to volatility.
Yes.
Right? Markets have gone down 10%. I think 60 to 70% of stocks in people's portfolios would be in the red, or would be, all the gains would have been wiped off that they would have earned over the last, let's say, 8 to 10 months, right? So I think I understand what you say, what you're saying when it comes to willingness, and that willingness is more about absorbing that volatility, waiting it out, and probably even putting in more money when that volatility is taking place. I think so. So we look at the economy, we'll identify what sectors we are going into. But how do we come down to actually identifying companies out of the 4,000, 5,000 listed companies?
So whatever number of companies we have selected in our universe, these companies needs to be analyzed at two-level basis. The first is the fundamental analysis. The fundamentals talks about the revenues those companies are making, the profitability, the cash flows, comparison of all these data with the company's historical performance and also with their peers in the same sector. The second leg is about the valuations. Ratios like PE ratio, PB ratio, dividend yield. All of these compared again historically with the peers and various indices at large. The combination of these help us identify which kind of company we should invest into and at what rate. Nobody would want to buy a good company at a higher valuation and capping their upside.
Yeah.
Everybody would like to buy a good company at a lower valuation so that they can get that return.
True.
So this is how the whole process is created, and we implement this, identify for ourselves and make the investment.
Yeah. So basically 4 steps. So risk profiling, economy, sectors, and then evaluating companies, right? And that involves a lot of financial formulas, looking at balance sheets. Now, I might even have the knowledge to do all this, the skill to do all this, the experience to do all this, but let's say with a regular, as a professional, or with a regular job or with a regular vocation, this is a lot of work. I simply may not have the time to do all this. How does one then tackle this scenario?
See, Saurabh, even if you have time, this is not a one-time process. This process needs to be done on a regular basis. Your portfolio needs to be analyzed at not only on the time basis, but also how the markets are performing. So practically, this is a day in and day out sort of a job. And in case you do not have such kind of time, or you do not have such kind of intent, even if you have the knowledge, my suggestion is that as an investor, somebody should actually go to a professional. Hire somebody who can look at the portfolio, who can help that investor design that, who has, as a professional, investing acumen, and help you out over a period of time.
Yeah. And I think professional advisors don't really cost that much either, right? In terms of when that person is going to work with your portfolio and get you additional returns, right, is going to optimize your returns, then that cost to pay doesn't really make a big dent into the extra that you make.
When we are talking about creating wealth over a period of time, then that cost is minuscule.
Yeah.
We need to let it go because that person is helping us out to create a financial future.
But, and what I also feel is that whether it's mutual funds or it's stocks, everybody's trying to optimize or maximize their returns. Of course, people need to understand that there's a risk element involved. But if that is your goal, I think there is a way you can still make your mutual funds work better for you. If you can't convince yourself to bear the volatility that is there in the stocks, or you are not convinced that you can trust somebody as a professional advisor, within mutual funds as well, I think mutual fund investing is way more than just Googling top 5 mutual funds and looking at those results, right?
So you're right, Saurabh. If you Google mutual funds, the top performing mutual funds, the answer or the result which you're going to get would be based on the historical performance. As an investor, when we are looking at wealth creation for future, we really need to look at the future activities of that particular scheme or a mutual fund as we say it. When we're talking about mutual funds, like in stocks, there is also a process of identifying which mutual fund and which scheme works. To understand that, the first step is we need to understand the fund managers. We need to know that fund manager. What kind of thought process the fund manager has. After all, he's a professional. Whether the thought process aligns with our financial goals, aligns with our thoughts, aligns with the kind of risk we would like to take. We also need to look at various other things. Certain ratios we are talking about. What the risk ratios, the upside capture ratios, the downside capture ratios. All of these things needs to be taken care of before we identify that this particular mutual funds I should park my money into. Not only this, we also need to understand the allocation. Are we allocating our money in terms of market capitalization? You must have heard about large caps, mid caps, small caps. At what market level, how much money I should invest into a small cap versus into a large cap? What is the right time to move my money from a small to a mid or a mid to a large? Also, we need to look at various sectoral indices. Sectorally, where as an investor, I would like to park my money. Whether I would, focus on the defense sector today, maybe a technology sector today. And even if I have decided which kind of sector I would want to park my money into, the question remains how much percentage. When it is the right time for me to move from one sector to another sector, looking the future.
So that means that just because a large brand, a large financial services brand has mutual funds, it doesn't automatically mean that these are the best mutual fund schemes to invest in. Like in stocks, there is an element of understanding the fundamentals of the mutual fund. There is an element of understanding the valuations at that point, that which sectors are properly valued or which market caps are properly valued. So I think actively, if somebody is looking at these things, rebalancing at the right time, there is still a lot of scope to improve returns within mutual funds as well.
If we do all this process, maybe we are able to get that upside or the alpha anywhere between 1% to maybe 3.5%. Right. And that is where the gain lies.
Right. So I think the key takeaways here for me are that the most fundamental thing to do is understand your risk profile. Where do people go and understand this, right? How does one actually measure their risk appetite?
We have a scientifically defined risk questionnaire. You can visit our website, lightpillar.in.
Okay.
And the investor gets an analysis about his ability and his willingness.
Right. And I think other than that, when somebody is looking at investing in stocks, what is important is the strength of their investing knowledge and their patience.
Patience
right?
is the key.
Right. And even beyond that, I think what we were talking about, and a lot of people with me will agree with me that the wealthiest investors are actually always working with an expert. So looking for a professional advisor, trying to find somebody you can trust is not that bad an idea when you're trying to invest a significant part of your corpus and trying to create life-changing wealth.
See, the professional finally gives you the added advantage of helping you decide on an emotional level where to money, how much money to park, in which particular company, in which particular mutual fund, and how long you should hold on to that.
Thank you for watching. For more such interesting discussions around investing, please follow and subscribe our channel, Light Pillar Conversations.